Good day, ladies and gentlemen. Welcome to Everyday Finances with Jay. My name is Jay. So how do you prepare for the 2020 recession? There is an enormous amount of uncertainties in the world right now. For example, the US trade war with China, social unrest in Hong Kong, England's exit from the European Union. All of that can contribute to a slower growth or potentially a recession. It is unanimous that no one can predict the stock market. But what we can do is to study the previous recession and learn from that. Today we're going to be looking at 6 different categories: stocks, bonds, gold, commodities, REIT, and cash. We're going to investigate how each of those categories performed in the previous recession, and at the end I'm going to share with you what I'm doing in each of those categories. So it was officially recognized that the recession started in December 2007 and ended about mid-2009. And the data I'm going to present to you today is going to be from that time period. The first category we're going to be looking at is stocks. Here's a picture of the S&P 500. In December 2007, it was at 1,468 points and dropped down to 735. This is a 50% decrease. I didn't know much about stocks and investing back then, but I can only imagine how that must have felt losing half or more than half of your entire portfolio, all that hard-earned money. But as of today, the S&P 500 has climbed up all the way over 3,100 points. So if you bought at a high price or a little bit lower than 1,468 before the recession, you would have more than doubled your money as of today. So my number one advice is do not sell when shit hits the fan, when there's a global recession, because that is exactly buying high and selling low. And don't worry, because the economy will eventually recover. Just look at what's happening today. The next category we're going to be looking at are bonds. Bonds have been the safer alternative to stocks where people invest in order to diversify their portfolio. But bonds were also negatively affected during the previous recession. Depends on which one you buy. The one I'm looking at lost more than 4%. The one after that is precious metal or gold. There's not much talk about it. And I don't understand why, because in the previous recession, gold actually went up by 11%. And after the recession ended, gold continued to climb. So you could have earned some money during the recession if you had money invested in gold. The next one I'm going to be looking at is commodity. Commodity is a fickle market because it can offset stocks when stocks are decreasing, but it can also decrease when stocks are climbing back up. The one we're looking at is DBC. Not only did the commodity rise in price during the recession, but also dropped down to a low during the recession. The next one we're going to be looking at is the category REIT, or known as Real Estate Investment Trust. The one we're looking at is by Vanguard. It's one of their index fund. It lost more than 40% during the recession. The previous recession was also called as the housing bubble because it caused the global economy to crash. So even if you invested money in real estate and lost 40% on your portfolio, if you did not sell and kept it, today's price of that same portfolio went up over to $90 per share. Looking at each of those categories, REIT lost the most amount of money. Following that is the stock market, S&P 500. And the safer alternative bonds also lost some money. It would have been better to have kept your money as cash because during that time period, inflation was fairly low. According to a study by UBS Wealth Management, a lot of the ultra-rich people in the world are increasing their cash holdings as of today. The 2 categories that did fairly well is precious metal and commodities. But commodities rose during the recession and eventually fell again at the end of the recession. But precious metals such as gold not only grew in their price during the recession, but also grew to about $1,900 in 2011. That is more than 100% increase through the recession and a couple years after that. There's this constant notion to diversify your portfolio. The most common strategy that I've seen is to invest in an index fund, which allows you to own a little bit of every company in that specific field. But that doesn't protect you from a global recession. Regardless of what index fund you invest in, during a global recession or a slowdown is going to be affected. So the reason why we looked into the 6 categories mentioned is to study which one has an inverse proportion, which means if one goes up, the other one will go down. So this way it will offer us a better way to diversify our portfolio instead of losing 25 to 50% of the entire portfolio. Maybe we can balance out the positives and the negatives. Here we go. Ta-da! As you can see, my portfolio is stock and cash heavy. I'm a big advocate for stocks because in the past century, stocks have returned on average 7% per year. My plan is to keep my stocks, commodities, and REIT at where they are. I want to keep about 15% cash reserve. That means I want to spend the extras on gold until gold reached about 10% of my portfolio, and then I will spend the rest of the cash amount on bonds. So if you have never bought any gold before, what I would do is there's many websites out there to buy gold. The one I use is called SD Bullion. I don't get paid to say this. So how would you go about it? Let's say if you want to spend about 10% of your portfolio on gold or precious metal, what I would do is determine the dollar amount and spread that out over 6 months or whatever time frame you want, so you don't get buyer's remorse, which means what if the price drops after you buy 10% all of your portfolio that you want to buy gold in? And there you have it. Today we went over 6 different categories, how they perform in the 2007-2009 recession, and I've showed you what I am currently doing in order to prepare for a potential recession. Please support this channel by subscribing and liking this video, and comment below if you have any suggestions, questions, or anything. Thank you.